Today I am going to teach you about the financial system. In that components of financial system, in that second one is financial market. Already we discussed about the financial institutions. Now we have to discuss about the financial market. The financial market is the marketplace where the actual transaction of the financial instruments taken place between the two parties or persons. It means whether two parties that is by borrower and lender, those two parties come together and join together in a marketplace or on a specific place, and they have to traded about the financial instrument. It is the financial market. The financial market can be broadly classified into two categories. In that, first one is money market and capital market. Money market is the marketplace where the short-term securities like treasury bill, repo, commercial papers, etc. are issued and traded over counter among the people. It means people or general public, they have to trade it instead of securities. They have to investment in the short-term securities like deposits or commercial papers or treasury bills for the less than 1 year. It is called as the money market. Next one is capital market. It is the marketplace where the long-term securities like stocks, bonds, debentures are issued and traded. BSc, NSC, NYSC are the some example of the capital market. Capital market is a market where the long-term securities like shares, debentures are issued and traded. It is called as the capital market. BSC means Bombay Stock Exchange, NSE means National Stock Exchange, and NYSE is, we have to comment on NYSE on about this. Then capital market is classified into the mainly two categories. One is primary market and secondary market. Primary market is a market where new issues are traded. It means initially startup companies sell their securities, or already existed companies issue the new shares in that market. Secondary market is a market where already issued shares are traded. Difference between the primary market and secondary market: primary market issues the new securities. Secondary market, whether primary market issued shares and debentures are traded in the secondary market. Then derivative market. Derivative market is the market where the financial instruments or financial transaction carried out through the contract basis. It is called as the derivative market. Next, third point is financial instrument. Financial instrument refers to the monetary document or contract between the two parties which are traded in the financial market. It represents the asset of the party and at the same time liability of the another party. Financial instrument is the monetary term or monetary base, or it is a contract between the two parties for exchange of the securities on the basis of worth of the money. Financial instruments are broadly classified into the two types. One is money market instrument and the second one is the capital market instrument. Money market instrument is the short-term debt financing instrument to the enhanced liquidity of the business, typically traded over the counter. It means for the short-term issues, or if require one financial institutions or person need for the very short-term period, it is called as the money market instrument. In that, first one is certificate of deposit. It is the dematerialized form of fund lent to the corporate for stipulated time period against interest earning. The operating procedures are the same as fixed deposit, provided any negotiable. Certificate of deposit is issued by the corporation or commercial or corporate organization to the general public for raise the income. Next one is commercial paper. It is the unsecured It is the unsecured short-term debt instrument usually having maturity period 7 days to 1 year, typically issued by the large cap companies for the purpose of funding commercial paper. More than 5 lakh crores paid up capital organization issues the commercial paper to the general public for raising the funds whenever working capital requirement is needed. Next one is treasury bill. It is also short-term debt instrument issued by the central government of India only having maturity period up to 1 year. Treasury bills are the government financing instrument. When government need the finance, at that time they have to issue the treasury bills through the RBI. Central government is not directly issued to the general public. It issues the securities on through the RBI. Next one is repurchasing agreement. It is called as repo. The commercial banks and other financial institutions borrow the funds from Reserve Bank of India for a short term through the repurchase agreement by selling government approved securities with promised repurchase in future date. It means when the financial institutions or financial organization needs the money, at that time they have to approach to the another bank. If the fund is not available, at that time they go for the last lender in the center in India. It is the RBI. They go for asking the loan or funds from the RBI. At that time RBI charge the one rate. It is called as repo rate for the commercial banks. Next one is call money. Whenever a loan is granted for 1 day or has to be repaid the next day, it is known as call money. It means in CC, one financial institutions or one nationalized bank requires the money. At that time they go approach for the another commercial bank or another financial institution for settlement of lump sum amount. If one customer requires the 1 crore rupees, at that time one central nationalized bank is unable to give that much of amount. At that time they go for another commercial bank to taking the loan and given to the who need that, who is the customer asking for 1 crore rupees. Then commercial bills. The commercial bills also traded in the money market and utilized to the raise funds against receivables due payments. Such practice of raising funds at the discount in called bill or invoice discount. Commercial bills or bills of exchange. You know that bill of exchange means when one person buys the goods or services on the basis of credit, at that time seller give the promissory note to the buyers and buyer accept that and put the sign and reverse to the organization or seller. When the seller is required the amount, at that time they go for commercial bank and presented the bill, and at that time this organization discount that bill and settlement of the bill to the seller. After maturity period they go for who will buyer and collect that amounts. Bankers acceptance. It is another money market instrument which are widely used in the financial market. A banker acceptance refers to the extension of loan to the stipulated bank against a signed guarantee of repayment in futures. In the financial market or in the financial institutions, they need for the financial assistance and get the loan from the another financial institution if they have to unable to repayment of such amount in a given period. At that time they approach to the another financial institutions to give the guarantees. Next concept is capital market instrument. Up to that we have to discuss about the money market instrument. Now we have to discuss about the capital market instrument. The capital market instrument refers to the long-term capital financing instrument, debt and equity. Traded on the recognized stock exchange, the corporations issue such financial instrument to raise the long-term funds from the general public. In that first one, equity share, preferential share, debentures, corporate bonds, derivative instrument. Equity share is the share, it have the voting right to raise the funds. Preferential share is preferential share is the share which have the preferential right to the repayment of the interest and principal. Debentures are the document which is signed and acknowledged by the organization to issue to the general public for raising the funds. It have the fixed interest rate. Corporate bonds. These are the bonds issued by the corporate organization to the general public for some period more than 2 years for raising the funds. Derivative instrument. Derivative instruments like issuing the securities on the basis of the contract. If one bond is issued at 2000 rupees and repurchased at the 2500, it is a derivative. Derivative markets those finance instruments which do not have their own value. Instead, its value is derived from the underlying asset. It is utilized to hedge the risk associated with the price fluctuation of the securities. In that forward market, future market, option market, and swaps. Forward market means sell the commodity today and accept the payment after 1 month or 3 months. Futures is the exchange of the currencies and payment resettle the payment in the future date. Options like the put options and call option. Swaps just like exchange of one commodity against the another commodities. Next components is financial services. The services offered by the financial institutions for the management, lending, borrowing and investment of the funds are called financial services. The are basically four categories financial service of India: general banking services, insurance services, investment services, foreign exchange services. General banking services. The services offered by the commercial banks or other banking institutions such as deposits of money, granting loans or advances, bill discounting, credit or debit card account opening, etc. Insurance service. The various insurance policies like life insurance, health insurance, general insurance or car insurance, etc. are sold under these kinds of services. Investment services. The various financial institutions such as stockbrokers, merchant and investment bankers, primary dealers provide investment and asset management services to the business and corporations. Investment services like loan syndication, underwriting of securities, trading of stock and other securities, merger and acquisition, fundraising services, depository services, online share trading, credit rating services. Next one is foreign exchange services. These are the special services which deals in exchange of foreign currencies. It means one person or one organization of the one nation is go or expand their business to the another expand business in the another country. At that time they need another currencies. At that time they have to converting one country to currencies to the another country currencies. Next one is the financial regulators. Financial regulator refers to the government bodies which are responsible for regulating, inspecting, monitoring the functions of various financial institutions like banks, insurance companies, business entities, non-banking financial companies, it is NBFCs. Financial regulators are the apex bodies of financial institution of respective sectors which registered and functions under this financial regulator institution. Few examples of financial regulators in India are below: Reserve Bank of India, IRDA, SEBI, FEDRA, FMC. Next concept is functions of financial system. The financial system fulfills the requirements of funds for business sectors. It means business sectors needs the money. At that time financial institutions or financial systems collect the money from the investors and this investment is put in the businesses. Next one, it brings economic growth by allocating the money to those who can better utilize it. It means channelizing the savings surplus or savings to the productive avenues. It leads to capital formation. It is already discussed about. Enables investment by business sectors. When the finance is available in the hands of the businessman, at that time they have to diversify or expand their business. If the business is expands, it is helpful to the nation by the taxes. Then it encourages savings and hence takes back money into circulation. If one salaried person savings in bank only, how to pay the interest? At that time, banks collects the surpluses from the salaried person and these funds is transferred to the business or productive avenues. At that time, business creates the wealth and transferring or repayment of the interest to the in bank and financial institution. This financial institution after the maturity period or after the some period they have to pay to the salaried person with principal and interest.